So I get a lot of calls from various prospects, and I got this one particular call that caught my attention because the prospect said, I'm losing a lot of money and I put my money in a safe investment. And I said, okay, well, where'd you put your money? And they said, I put it in Aristocrats. And I said, well, I don't think you can invest in Aristocrats. So where did you put your money exactly? And she's like, I put it in Aristocrats. I watched a YouTube video and I put my money in Aristocrats. And the more I talked to her, the more I began to tease out that she'd watched a YouTube video about putting your money in dividend stocks and specifically dividend aristocrats. Now, dividend aristocrats are stocks that are companies that have paid out a dividend over the past 25 years, and over those 25 years have continued to increase their dividend. And so it seems like a safe bet. But in her case in particular, she put a lot of money into AT&T, which is one of the dividend aristocrats. It had a high yield. It had always increased its yield, and they cut the dividend. So not only was the dividend reduced, but also the stock price was going down. So in today's video, I want to look at 5 problems that I see from investing in dividend stocks. Hi, my name is Kevin Lum. I'm a certified financial planner based in Los Angeles, and this channel is dedicated to helping 1 million people retire without worry. Now, if you spend any time on YouTube or surfing the web, you've probably seen an article or a video with the title something like this: the top 5 dividend stocks for 2023. And they'll then go through and talk about dividend stocks you should invest in for the upcoming year. And they'll have the yields, they'll have 5% yields and tell you why it's a great company. But what they don't tell you are some of the downsides from investing in dividend stocks. And so today I want to walk through 5 problems that I see investing in dividend stocks. Now, the first challenge that I see or problem that I see is people will yield chase. And so when they want to invest in dividend stocks, they think, okay, I want to make a yield. And so they're going to screen for the stocks that pay out the highest dividend and just choose the highest paying dividends. But that is not always a good strategy. In fact, companies that have the highest dividend payout are often the most problematic companies. And there are a number of reasons for this. Now, one of the reasons could be that the stock price has plummeted, and so that drives the yield up. Another reason could be that the management is trying to placate the investors because the stock has been declining or is flat and not doing anything. But what you need to realize is that when management is paying a dividend to the stockholders, that is money that they are not able to invest in growing the company. They're not able to invest in research and development. They're not able to invest back into the company. So when a company is paying out a massive dividend, that's money that is not being invested in that company. Now, there are some dividend stocks like a real estate investment trust where they specifically have to pay out dividends. But even then, when you have a really high dividend payout, there's often more to the story. And so a problem that I see over and over is that when people chase dividend yields, they're just looking for the highest yielding dividend stock, they often end up getting burned. I mean, you saw this particularly with AT&T. A lot of people piled into AT&T because they saw it had a high yield, it had a fairly stable stock price, and it was a dividend aristocrat. It had increased its dividend payment for the past 25 years and had not cut its payment. But there were a lot of problems underneath the surface at AT&T that not everyone realized. They'd taken on a massive amount of debt to finance purchasing Time Warner and a number of other acquisitions. And so they were drowning in debt, and that dividend payout was keeping them from being able to fully pay back their debt. And so the management, for a number of reasons, had to cut that dividend back. Now, that is just one high-profile example, but it's a great example because if you're just screening for dividend stocks, AT&T checked all the boxes. It was a high yield. It was a dividend aristocrat. It had a stable stock price. It looked like a great investment. But if you'd invested money in AT&T, not only would you have had your dividend cut, but you'd also seen the stock price decrease dramatically. The second problem that I see with dividend stocks is that dividends aren't guaranteed. I think sometimes people think of them as a bond payment, as almost like a coupon that you receive for that stock. But dividends aren't guaranteed, and companies do suspend or decrease their dividend payouts on a really regular basis, especially during an economic crisis. So you saw this during the great financial crisis a few years back. Almost half of the companies suspended or reduced their dividend payouts, and you saw the exact same thing happen during the COVID crisis. I have a quick graph here that just shows the number of companies that either reduced or suspended their dividend payouts during the COVID crisis. And so at the exact moment that you want your portfolio to be stable and to continue to pay you income is the moment that it often ends up getting cut. So if you built your entire portfolio around income producing stocks in retirement, and then you hit a great financial crisis, or you hit the COVID crisis, both of these have taken place in the past 10 to 15 years, your income has taken a massive hit. And so it's just not guaranteed. Companies do cut dividends, and more companies are suspending their dividends altogether in favor of stock buybacks. Now, there's a number of reasons for that happening, but the problem with dividends that companies have discovered is that when there is a financial crisis or a financial downturn or an economic disruption, if you have a dividend that you're paying out, it makes it harder for the company to have as much flexibility. It makes it harder for the companies to pivot financially without cutting their dividend. And when you cut your dividend, then it ends up depressing the stock price. And so a lot of companies have discovered that stock buybacks are a better way to return value to shareholders, because when a company repurchases its stock, it raises the price of the stock, but it also is more flexible. So if you stop a stock buyback program, it doesn't have the same impact on stock prices in people's portfolio as if you cut a dividend. So you're seeing companies move away from paying a dividend to a stock buyback program. The third problem I see with dividend-paying stocks, or a portfolio of dividend-paying stocks, is it often lacks diversification. So around 60% of companies don't pay a dividend. So that leaves only about 40% of companies to pay a dividend. You have a very reduced universe of stocks to invest in if you're investing in dividend stocks. And in addition to that, dividend stocks tend to be concentrated in particular sectors. So think oil and gas, banking, in the financial sector, utilities, more established companies. Those are the companies that are paying out dividends because they're not growing as fast, and so they're not investing in research and development in the same way as, say, a technology company would. But that also means that your portfolio just isn't as diversified. And one of the most important things for anyone when they're constructing a portfolio is having as much diversification as possible so that you can insulate yourself from financial shock. So when you focus simply on dividend stocks, you reduce the diversification of your portfolio, reduce the universe of stocks you can purchase, which means you are more concentrated and have more risk. In just a moment, I'm actually going to walk through and show you the difference in the risk profile of a portfolio that just goes 100% in the S&P 500, which I would not recommend, or a portfolio that has individual dividend stocks, and just looks at the risk profile of those two portfolios. Now, the fourth challenge with dividend portfolios is that they aren't very tax efficient, particularly in a taxable account, and it makes it hard to control your income. So let me give you an example. If you have a dividend-heavy portfolio that, say, has a yield of 5%, you have $100,000 in that portfolio, it's going to produce $5,000 of income each year. If you're in retirement and you're trying to control your income, say because you don't want your Social Security to be taxed, that $5,000 is going to be paid out, and there's no way to control that payment. Whereas if you were focused on capital appreciation and you didn't need to take the money in that particular year, you could let that money continue to grow. And then when you needed the cash, you could sell it. The problem is when you have a dividend stock, that dividend gets paid out each quarter, or whatever the rate is it gets paid out on, but it's going to get paid out each year at some interval. And so those dividends are going to be paid out to you. And when those dividends are paid, you're going to have to pay tax on them. Now, dividends are paid out a number of different ways. You have qualified dividends and you have non-qualified dividends. A real estate investment trust or REIT or master limited partnership would be a non-qualified dividend, and that's going to be paid or taxed to you as ordinary income, whereas a qualified dividend is going to be taxed to you similar to capital gains tax. So the tax rate isn't as big of an issue if it's a qualified dividend because it'll be similar to long-term capital gains. For me, the issue is the inability to control your income. And this becomes really important when you're trying to control your tax bracket, right? You don't want to bump up in the next tax bracket, or you don't want to pay tax on Social Security, or you don't want to have the IRMA surcharge on Medicare. So a dividend-heavy portfolio just makes it much less tax efficient and much harder to control your income. Now, the fifth challenge that I see with dividends is that they carry a significant amount of risk, particularly when you are choosing individual dividend stocks to invest in. If you invest in, say, just a dividend ETF that has a large collection of dividend stocks, often the yield is going to be a bit lower, but you have diversified some of that risk. But what I see a lot of people doing, at least based upon the YouTube videos I see and the blog posts I read, seem to indicate that a lot of people are choosing individual dividend stocks to invest in because often they can create a higher yielding portfolio. And so what I did, and you'll see here in a minute, is I used a software called Portfolio Visualizer. I'll put a link to it in the show notes. I think that everyone should have Portfolio Visualizer saved in their browser if you do anything with stocks. It's just a great way to back test things and check different things out. But what I did with Portfolio Visualizer is I took the S&P 500, which I would not recommend just solely investing in, but I took the S&P 500, and then I also took 10 dividend stocks and put 10% in each of these different dividend stocks. And then I had it pay out a 5% yield per year. And you'll see what happens to those portfolios from 2010 till today. Now, one thing I want to mention is you might wonder, like, how did you come up with the dividend stocks that you invested in? Basically, most of the dividend stocks that are included in these portfolios, I tried to provide a little bit of diversification. So different industries, so not everything was concentrated in one particular industry. In fact, one of the stocks you'll see in there is Pfizer, which had a very good run after COVID. So that actually, I think, helps this dividend portfolio perform a little bit better. But there's a real estate investment trust in there. You'll see Pfizer. I think there's some financial institutions. You'll see the breakdown in a minute. But I found a lot of these stocks by simply Googling top dividend stocks for 2013, which had been about 10 years ago. And I looked at a list from Jim Cramer and a list from the Motley Fool, both sources that a lot of people go to for finding dividend stocks. And then I put these dividend stocks in, I put 10 stocks in, so there's some diversification, 10% to each one. And then I just ran a back test to see how the portfolio would have performed. And what you're going to see is not only does it underperform significantly, but it actually has more risk than just putting all of your money in the S&P 500. So let's take a look. So now we're on Portfolio Visualizer. It's on my second screen, so I'm going to look away here for a minute, but I'm going to scroll up the top. So this is Portfolio Visualizer. You can set the time frame, so what period. So I'm going to look at basically a 10-year period from 2013 to 2023. And I'm looking basically in that time period, because I chose this article, the top dividend stocks that you should invest in for that period. So these aren't, basically most of these are highly recommended. And I tried to do some diversification. So you'll see Bank of America's in here, Pfizer's in here. So you have financial, you have pharmaceuticals, you have Intel, which is a tech company, you have a REIT, a real estate investment trust. And so you actually have a bit of diversification in the companies that we've chosen. And then you see that we started with an initial amount of $200,000. And then we're going to take out $800 a month from both portfolios. So both portfolios are going to have a $800 a month withdrawal. We're going to rebalance it annually. You can see there we're using the S&P 500. We call it the custom dividend portfolio. And then hopefully my camera I think my camera might be over, or my screen might be over top of this. You may not be able to see, but I entered in these different names here. So, you have the first OPI is the real estate investment trust, and then we have AT&T, PFE is Pfizer, INTC is Intel. So anyway, we have these 10 companies, and then I click Analyze Portfolio, and then we're going to get the results. And you can see here that had we started with $200,000 with the dividend portfolio, we would have ended, today we would have about $296,000, which isn't terrible, but that's only a annualized return of about a little over 4%. Whereas if we just put the money in the S&P 500, we'd had almost $475,000, almost $200,000 more than the dividend portfolio, receiving the same amount of income. So it's not like you had less income during that period of time, but you have a significantly larger amount of money. Now, I don't want you putting all your money in the S&P 500. You want a balanced equity portfolio. But if those are your two choices, what I want you to see is you actually had less risk investing in the S&P 500 than investing in these dividend stocks that were claimed in 2013 to be some of the best investments for dividend stocks. And they're great companies. Intel's a good company. Pfizer's a good company. So it's not like a lot of these are junk companies. And so you see your annualized return with the S&P 500 would have been 9.16. But here's what I think is really interesting. The standard deviation between these two portfolios is lower, and that's the volatility in the portfolio. How kind of the movement of that portfolio is significantly less the S&P 500 than in the dividend portfolio. Now, part of that's because the dividend portfolio is way more concentrated. So you have 10 names as opposed to 500 names. You're going to have more volatility. But if you're investing in dividend stocks because you think it's safer than investing in the S&P 500, you should know choosing individual dividend stocks opens you up to a lot of risk and volatility. And then you see here, the best year is about the same for both of them. The worst year is worse for the dividend portfolio. The max drawdown is worse. And then the other number you should pay attention to is the Sharpe ratio. So the Sharpe ratio, higher is better. And it's based not only on the return of the portfolio, but also the risk of the portfolio. And so as you can see, just investing in the S&P 500 would have had a higher Sharpe ratio because it's a better return and less volatility in the portfolio than the dividends. And at the end of the day, you still end up with more money. Now, you can make a good case for dividends. And so I don't want you walking away thinking that the whole point of this video is just to destroy dividends. But I do think you need some balance, particularly if you've seen all these other videos telling you these are the best dividend stocks to invest in, and you're counting your money, and I see tweets out there where people are talking about, I'm investing in dividend stocks so I can have this passive cash flow. The problem is that it's not as fixed as you think it is. It's not guaranteed. You're open to a lot of risk of both the stock crashing, of the dividend being suspended or the dividend being cut. And the times that it's going to be cut or be suspended or be at most at risk is the time you most need your portfolio to stand up and provide you protection. And so for most people, you are way better off just investing in a balanced equity portfolio rather than investing directly into dividend stocks. Now, there are dividend funds, and some have done quite well, but as you'll notice as you start looking, the yields are fairly small for a lot of those dividend funds. So before you invest in dividends, you just need to take into account, right, the challenge and the danger of yield chasing. And the most dangerous thing you can do is just invest in the highest yielding dividend stock. That, if you remember nothing else from this video, remember that. But you also just need to remember that you are much less diversified when you're investing just in dividend stocks. And at the end of the day, I think you're opening yourself up to more risk over a broader balanced equity portfolio. And I don't really see that there's any outsized returns. The other thing I think that's happening, and I think people who are really into dividend stocks have not paid attention to, is that the world is changing. Less and less companies are paying out dividends now than they used to, and are moving more towards stock buybacks. And I think stock buybacks are a more tax-efficient way for the investor to receive that dividend. And it also gives the company more flexibility during times of economic crisis. They don't have to cut their dividend. They can just not buy back as many stocks. And the benefit for the investor is as the company buys back the stock, the price of the stock will increase. And so you're getting capital appreciation as opposed to dividends. And the good part about that is you can control when you sell it, so you can control when you receive that income, which just is much more tax efficient, particularly in a taxable brokerage account. Hope this was helpful. If you like this content, as always, if you do me a favor, click the like button, subscribe, ding that bell, leave a comment. If you have a question, something you're wondering about that didn't get answered, or if you have a favorite dividend stock, if you think I'm completely wrong, or there's a video that just destroys my argument, feel free to drop it in the comment section below. I read every comment, and I like interacting with all of you. So thanks again for watching.